Okay, here we go. Thanks. Good morning, everybody, and welcome to the CICMQ Zoom sessions today. I'm very, very pleased to be able to welcome Grant McDonald, who's one of the directors of financial crime at Experian. Experian are, as everybody knows, a long-standing credit reference agency. I've known Grant for a long, long time, and I'm very, very pleased that he is able to join us. Grant, you're currently you've taken your video off, but I'm going to put you as a host now. And there, he's back in the room. I'm just going to make you a host, so then you can share your screen with your presentation.
Wonderful. So whilst I'm sharing my screen, I might just stop the video for a second, just so I'm not seeing my face. Share screen. And give me 2 seconds.
Okay, talk amongst us. Here we go. Great stuff. Okay. Okay, great. Yeah, we can see that. I can see that. Everybody else see it? Thumbs up if you can. Excellent. Thank you, Charles. Okay, everybody. Over to you, Grant.
So, thank you very much for the intro.
You've just unshared your screen.
It's seamless. This.
Seamless. Well, yeah, you could say that. Just share your screen again.
Share again.
There we go.
Wonderful. Excellent. So hello everybody. I mean, absolutely, I've a lot of familiar faces on the call today. So name's Grant McDonald. I'm a director for financial crime at Experian. Been with Experian for some 20 years. Chris contacted me a few weeks ago and he was asking me about, in preparation for today's session, could I maybe offer some insights in terms of what we saw in the last economic downturn, in terms of whether we witnessed an uptick in rates. So I've to start with today, I thought I'd introduce some sort of insights that I've come across over the last couple of days. So back in 2009, we saw first-party fraud increase from 28% of all fraud to 46% through 2009. I've also come across an interesting stat from CFAS saying that they had a 55% increase in false insurance claims in 2009. This recession and the stuff I'm going to take you through today, it's not really comparable to what we witnessed back in 2008, 2009. I think you do notice an uptick in frauds when people are finding they're under financial pressure. At the moment, it's subtly different. The key difference is the government interventions. So we are seeing unparalleled or unwitnessed before support from furlough schemes, bounce back loans, CBILS. So you've got the coronavirus business interruption loan, if that's familiar to you. You've got business rate holidays. Now, we do expect that some of these schemes to support UK citizens and employees, that's going to stop, and absolutely those kind of high fraud rates, those upticks that we witnessed just over a decade ago, they might well resume. So I think today there's a couple of things I want to take you through. One is just some slides about the current economic landscape. So I've been moonlighting somewhat this last few weeks since COVID came about in March. So I've been working with the Experian's analysts and consultants. And we've been actually preparing the stats for number 10, no less. And the question that we've been posed is, can we understand what the cash flow position of the nation looks like? So some of you may be aware that from the UK's CMA 9, so that's the 9 UK largest banks, they are mandated to share data with Experian around companies' income and expenditure. Now, this puts us in quite a fortuitous position in that for any given company in the UK, we can understand what their cash position looks like. We can also therefore understand what a drop of income and how it would impact their business. So if we understand their cash position and we can see that income is not forthcoming, we can start to calculate how long will it be before they fully deplete their cash reserves. And then what we've then done is then create that macro view. So how do we take all of that company level data and build that into a view of the UK outlook? So we can start to see, well, actually, we think these are the sectors that are under greatest stress in the UK economy. And we think this is the number of weeks or months that this sector will be able to cope with until they hit serious cash flow difficulty. So we'll talk a little bit about that. And then we're going to move on to an example of commercial fraud and what you need to be looking out for. And then we'll finish off with a case study. And then as we go through, I mean, by all means, if you've got any questions, please ask away.
Yeah, there's also questions in the chat box as well. If anybody wants to ask a question without interrupting Grant, just stick it in the chat box at the bottom there.
So the work we've undertaken, the first thing that we've done is looked at how can we segment the UK business universe. And we've created 4 key segments. One of these will be very familiar to you, and that's the one at the top left. So you've got your non-essential. You'll have heard about these from your government briefings each day. So your non-essential is your cafes, your restaurants, your pubs and your clubs. You've then got your adaptive businesses. So that's your telcos, technology, software providers. You've got your essential, actually doing okay at the moment. So that's your pharmaceutical companies, your supermarkets. Other businesses, kind of a broad definition, but that's your old traditional UK segment of the economy. So that's your goods rather than your services. So your construction, manufacturing, wholesale, and below that, in these in these boxes here, you can see what the prognosis looks like for these sectors. So by way of example, today, I'm only going to focus on the non-essential segment and the other businesses segment, and we can see for both of those segments, the prognosis is not a good one. For the non-essential market, we know that's been very difficult. Effectively, they've been forced to shut down. Bottom here, you can then see how many companies sit within each of these segments, and in terms of what's going to be the impact in terms of the consequential impact to UK employment. So before we start diving into these segments, so this graph here looks at the 3 million UK businesses that sit within the SME bucket. So this is taking all of this information from the CMA9. Ordinarily, we would not be able to share this information with you. It's only through a government exemption that we've had in March that we've been authorised to share these levels of insights, because we think it's in the best interests of UK business and the UK economy. So I want to cast your eye to this right box, and this is working on a scenario that if these 3 million SME businesses had no income coming in, how many weeks would it be before they would fully deplete their cash reserves? And the alarming figure here, if you look at this kind of red block here, we're seeing that 1.5 million businesses of the 3 million businesses in the UK today would run out of cash in 4 to 8 weeks. Now, I should mention, these stats are about 4 weeks old, so you're really looking at an outlook of about 4 weeks. This is a bleak picture, and I think it's overstated. I think in reality, it's not the case that all businesses in the UK don't have an income coming in. So I think in a second, we'll have a look at the income scenarios at the bottom and really focus on what we think the real impact is.
Grant, could you do me a favour? Could you let Nick King in? I know some people probably don't want him there. If you can let Nick in. Yeah, there's Charles waving his hand. If you can let Nick King in, if you've got a participant, and let him in. He's sitting in the waiting room.
Wonderful. Has that worked? Nick, are you with us?
Yes, I think it has, yeah. Thank you.
Oh, we've got another gentleman as well, Tim Annis.
Oh, Tim, yeah. Well. Okay, great, thank you.
Okay, so if we then move one slide forward, so if we then look one slide forward, so those 1.5 million businesses I mentioned earlier on, where we're saying that if they had no income, they would run out of cash reserves in 4 to 8 weeks. The impact to UK employment is 17 million. So again, coming back to reality though, let's go back to the segments that I initially introduced at the beginning of this presentation. So the non-essential segment, the cafes, the pubs, the clubs. Okay, I think the no income scenario is an accurate one here. So we've got 359,000 limited companies sitting within this segment that we believe will run out of cash pretty imminently. And the consequential impact to UK employment for that segment at 6.2 million. For your other businesses, so again, the old traditional part of the UK economy, your goods rather than your services, your factories, your energy construction, real estate, we're saying that on an income scenario of 25%, we think that 328,000 businesses will run out of cash in the next 4 weeks. And again, with the consequential impact to UK employment at 4.6 million. Conscious, Chris, that an awful lot of the attendees on today's WebEx come from a credit and risk background. So I guess in terms of the key takeaways here, I think I think if you have a look at the bureaus, so whether that be CreditSafe, Experian, Dun & Bradstreet, Equifax, when we build scorecards, we're building those scorecards to predict the probability of business failure. And when we're developing those scorecards, we usually do it during a period where the economy is benign. It's not as turbulent as we're witnessing now, certainly not designed for a pandemic. So I think the overall message here is that you probably need to leverage cash flow insights to understand whether a business is financially solvent and what their outlook looks like. So I know that you touched on this briefly in the introduction. So Experian has been working on leveraging this type of information to create a volatility index that will supplement the commercial Delphi score. And principally what that's looking at is if you've got a business, we really need to understand, first of all, what sector does it sit in? That's become more important than anything right now, because it absolutely is the case that some sectors are being more adversely impacted than others. We then are working with our economists to understand, well, what's the economic outlook for that sector? We then need to look at the payment performance. And then very importantly, that cash flow piece I just spoke about now, understanding cash flow position and understanding income coming in, how income has been impacted, and then starting to calculate the point at which we think cash reserves will be depleted and therefore they'll be running into cash flow difficulties is becoming ever so more important. So a couple of last slides just in terms of economic outlook. Many of you will be familiar with the days beyond terms. So days beyond terms is a measure of how many days a company is taking to settle monies owed. And we can see that over the last 4 months, we've seen a consistent increase in the days beyond terms across all sectors. So we've had an 8.4% increase over the last 4 months, going up against the UK to 23.4 from 21. I guess the final point I'll make here is if you look back in this slide, this looks at the business closures over the last half a century. Now, you might be alarmed to see that business closures has been consistently increasing over the last 50 years. It's not a real concern. It's only growing proportionate to the growth in the UK business universe. So, I mean, if you look at the UK business universe, we had 1.5 million registered businesses back at the turn of the millennium. We've got about 4 million businesses today. The bit that is interesting, though, is if we have a look at just after the last economic downturn, 2008, we had about a year lag, and then we had this massive spike in business closures. So again, exactly as I was saying with the frauds, I think that we are not witnessing an uptick in frauds yet. We're not necessarily witnessing a significant uptick in the business closures yet. I think what we are doing is readying from a credit risk point of view. Is how can you make sure you're leveraging additional insights beyond just the scorecards and isolations to make sure you're best positioned to understand financial risk of your customers. And I think from a fraud perspective, I think it offers me a nice segue just to touch on an example of fraudulent behaviour that we're witnessing right now. The example I want to talk to you about today was Phoenix Businesses, and actually how can we use this example to better explain how you can better identify potentially bad actors that are either coming through in your applications right now or indeed already exist within your portfolio. This example I'm going to show you, it's real. So none of the figures that I'm going to take you through today are falsified. What I have done to my behest is I've had to change the names of the individuals to get approval from Experian, because there is some sensitive data in here. We've had to anonymize the dodgy individuals that sit behind this business. So the company here, what I'm going to talk to you about is, so the company's called Zing Republic. They set up in January 2014. It's a restaurant. You've got the current director, Ahmed Hussein. His date of birth is August 2000. I'm emphasizing that for a reason. It builds back into the story later on. So remember Ahmed. The gentleman we're going to focus on really as we go through this timeline is Abbas. Abbas is the previous director. And again, if you looked at your bureaus, your Experian, your Dun & Bradstreet, your Equifaxes, and you assess this company, the credit score might be a little bit misleading. It looks pretty good. You've got a good credit score, you've got a good credit limit. But if we have a look into Abbas set up his first company in 2012. It's a company called Clinic Nation. We can see from the Birmingham Mail that they are involved in non-surgical cosmetic surgery. And then if we have a look at 2013, Clinic Nation changes its name to Cosmetic Consulting Room Limited. 2014 to 2015, they start to run into some difficulty. We can see £42,000 worth of unpaid CCJs, and in 2015 they're liquidated by the court. Nothing really of alarm yet. However, if we look back at 2014, what is going on here? So we've got Abbas, and he has set up another 18 companies. And this is so common. We're seeing this all of the time now with these Phoenix businesses. So before, once they've generated the debt, and before they liquidate, liquidation administration, before they wind up the businesses, they're setting up these other organisations. They're transferring their assets, and they're trying to continue to trade seamlessly. So I'm going to stop for a second. So if we have a look at this business, again, this is real. You'd think I was making this up. So we've got Purple Sales, advertising a property in Edgbaston at 2.75 million. So we can see here, beautiful country manor house, lovely dining hall, very attractive garden. If we delve in a little bit more deeply, we can see that actually that country house featured on the BBC series The Planners. The dining hall is a random image from Audley House in Mayfair in London, and the garden is from an image taken from a landscape gardener in Connecticut, USA. So I'm starting to develop a picture here that this individual certainly looks suspicious. So back to my timeline. So we go back to 2016. Again, just an absolute splattering of activity, new businesses being set up. And if we then have a look at the financial performance of all of these businesses, they are entirely aligned to what we witnessed in 2014 with Cosmetic Consulting Room Limited, £42,000 worth of unpaid CCJs. This individual, Abbas, is now director of all of these companies, and 17 of these companies have generated keys defaults and or unpaid CCJs totaling £142,000 against them. So if we have a look in August 2016, I think Abbas is feeling the heat under his collar. I think the pressure has got too much for him. And therefore he resigns as director from all of these companies. But can you remember that other gentleman that I started at the very beginning of this timeline? So we go back to Ahmed. On his 16th birthday, on the date that Abbas resigns from all of these companies, Ahmed is appointed director of 19 of them to pick up his father's legacy, including Zing Republic Limited. And actually Zing Republic Limited, the previous name is Purple Homes Limited. So there is a spider web of, I would argue, fraudulent activity. You can look at this as credit risk, but this is, I think there's too much of a pattern here to challenge and question whether this individual is a credible and legitimate individual. Finding all of this intelligence, if you were to do this, it's an impossible task. How do you gather all of this information? I wanted to talk to you about a little bit of technology, a bit of techno geek for a second, graph databases and network analytics. So if you use traditional means, so if you look at Excel, for example, it has rows and it has columns. And therefore, row and column A1, it's quite difficult to match it to row and column C3, for example. And therefore, what network analytics allows us to do is effectively match all of the cells within a given database. So if we have a look at the example here, we've got Zing Republic, and we can see on the right here, we've got cosmetic surgery. We've got the directors behind it. So we've got Abbas, who's the previous director. We've got Ahmed, who's now the recently appointed director, and actually he's also the person of significant control ahead of Zing Republic. And then if we click forward and we look at cosmetic surgery, in Experian's determination of Phoenix businesses, we've created a Phoenix business flag, and it's at that point we've then been able to visualize very quickly. These are all of the businesses that are associated to that cosmetic surgery firm that we looked at earlier on, all linked back to Zing Republic and all linked back to Abbas. And then we can click, when we click on Abbas, then we can see another smattering of businesses all linked back. So it's only at that point that we can start to see that these are all Phoenix organizations, to these organizations here in blue, and that we've got Abbas and Ahmed linked together. So I think we're at an opportune time to almost intertwine the data that's available from the bureaus, so from your Experian and indeed any other bureau, and look at how we can use this connected data and surface it through technology. So I've got some examples here. So the example I've used just now is using Experian's definition of bad. So we've created this Phoenix business flag, but I think the reality is you on the call, you'll have your own definitions of bad. So your definitions of bad could be that you've got a suspect file where you've got individuals, unscrupulous individuals who have defrauded you in the past. You might just have serial debtors who you've spotted and you want to look at. And once you've got either that external view of bad coming from Experian, your internal view of bad, or indeed it could be from, you'll be familiar with maybe with Hunter and CFAS. So CFAS is your known fraudsters. So CFAS stands for Credit Industry Fraud Avoidance System. And Hunter is a known fraud sharing network. So irrespective of your definition of bad, what are the means by which we can start connecting people who we know are bad to one, your applicants, and two, your existing customers? So the example that we looked at a second ago was the directors. So we can see that Grant McDonald perhaps is a director on your suspect file, and we can then say, well, actually on the applicant coming through or in your customer portfolio, we can see that Grant is also director of other businesses, and making sure you're understanding that association. If you're involved in serious and organised crime, you'll have heard the term ultimate beneficial owner, and that's when you traverse up and down a corporate structure, and many levels up, you'll see the ultimate beneficial owner. And what you can now do is, again, you can see, well, actually in your suspect file, you might have Grant McDonald as the ultimate beneficial owner. And again, in the applicant coming to you, ABC Limited, you might not see any connection with a bad looking at the business, but again, several levels up the corporate structure, you can see that the beneficial owner of the business is the same. I guess two last little examples. So the other one is corporate hierarchy. So again, if on your bad file, you've got ABC Limited. Now, companies are hierarchical. You've got sites, subsidiaries, you've got parent companies, you've got ultimate parent companies as well. And therefore, if you can see ABC Limited is bad, and your new applicant is for BCD Limited, and BCD Limited is a subsidiary, a parent, or an ultimate parent, how can you create those associations? And then there's the third, which is, I think, is the really clever bit. And this is about how can we link, using the Consumer Bureau, businesses to individuals. So I think the example I can now give you is that Chris Sanders and I, we are in cahoots together. We share a joint bank account. We've got that joint bank account with Lloyd's, for example. So I can now see that Grant McDonald is the director. I use the home address that's at Company's House, which you're not allowed to have access to because it's private. And I can then connect that to say, well, I can see that Grant McDonald and Chris Sanders share a joint bank account through the Consumer Bureau. I could also, in my example, say that Grant's bad, and the new applicants come in from Georgina, which is Grant's wife. And again, using association alias data to try and link family members to suspicious activity. So I think the way in which you can leverage connections and technology has really opened up a new world of opportunity. So I guess the question that we asked at the beginning, would you extend credit to Zing Republic? I think the overwhelming answer now is absolutely not. Abbas is clearly a dodgy gentleman, and I think how can we, again, a bit like I was talking earlier on about from a credit risk point of view, making sure that we supplement your credit scores with cash flow insights to make sure you understand and can accurately determine probability of default. The same applies for fraud. It shouldn't be considered as part of credit risk. We need to look at it in combination to make sure it's not separate disciplines. I guess my very final bit before I open up for questions is just to give you a case study. So I've been working with a very large energy company, and they've said to me, Grant, is there any way you can take all of the key defaults, so basically my bad debts, and tell me where we can associate it to common directors? And the results that we got were astounding. So we've identified that this energy company has written off over £2.4 million worth of debt, and they actually have £100 million worth of live debt where they're already trading with businesses that link back just to 1,500 directors, which we think are questionable. And actually, when we were looking at one of the worst offenders, we've actually found a reasonably sizable pub chain in the UK, and it's run by 2 directors. And through this process of using network analytics, we've been able to start to see, well, actually, we've got the pubs in this part of the portfolio here, we've got another pub here, another pub here, and we can start to see that linked to these directors, we've got all of these debt amounts building up to quantify the sheer magnitude of the debt associated with this fraud, the debt associated with this pub. We've actually found that this pub for this energy company, they've set up 118 separate accounts across 19 different businesses, and that one director has over £471,000 worth of debt written off against him. So I think it's a good example to kind of bring together that fraud and credit risk aspect, because in many respects, and I think this is very true in the energy space, they don't think they've got a fraud issue, they think they've got a credit risk issue. And I think what we're firmly trying to prove here is that it's not a credit risk issue. These are unscrupulous bad actors, and actually with better governance and better preventative measures, then you can more easily identify the good and bad, better discriminate good from bad, and then make sure you're treating your customers accordingly. So I'll pause for breath at that point, Chris, and maybe start my video up and open up for some questions.
Yeah. Do you have any more slides on this now, Grant, or not?
No.
Okay.
I've got some background slides. If the conversation takes us into anything that I need to look at, I might.
Okay. I'm just going to unshare. Unshare. There we go. Okay. Yeah, so, well, thanks very much, Grant. When I saw this presentation the other day, Grant took me through it. I thought, my God, that's a bit scary. Which is why I thought it would be useful for us to see as well. Thanks very much. Massimo says, how will Brexit affect this type of analysis, especially for EU-based firms, Grant?
So Massimo, we've been working with our chief economist in Experian to develop the Brexit scenarios to look at how it's going to impact the economy. I'll pop that all in the bin because with the pandemic coming through in March, we're having to work through the scenarios and how that's impacting us. I think we can see very clearly the segments of the UK universe that are being adversely impacted. So I think, whereas before, I think Brexit was discriminating more to those businesses that were exporting, and therefore there was a bit of a bias in terms of the businesses that would be most severely impacted. The pandemic is indiscriminate. I mean, it really is impacting all businesses, albeit it's impacting some businesses worse than others. I should mention, though, Massimo, I'm not an economist. So if we want to look more at Brexit and the pandemic together, then I probably should introduce you to one of our economists who are probably better versed at giving you more detail on that.
Yeah, my concern will be more in regards to access to the actual data that you can analyze, because my guess is once the UK is out of the market after the transition period, you will not have access to that type of data for EU-based firms. It's not the economic background of the analysis. I think that's a great use of data analytics and artificial intelligence. I think it shows what you can leverage when you have good systems in place. So I think on the economic background, I think the economics are sound. I can see how that works really well to manage the risk. My concern will be in terms of the quality of data you'll be able to gather about European companies once you are completely out of the European Union on the 1st of January next year, which I don't believe you're going to have access to the same type of data. That's my concern.
No, so just to touch on, Massimo, on the access to information. So all of the slides I presented today is a macro view.
Okay.
What you need is a micro view to really differentiate your treatment strategies and make sure you're treating customers fairly and responsibly. You need to have access to that data. There's some advancements that have been made. So again, from a capital point of view, Again, if any of you on the call are contributing to payment performance schemes, you'll now have access through crossover agreements to get access to some of these cash flow insights that previously you wouldn't have had access to. I think that the second bit, and because of what's happening is impacting cash flow so severely, Massimo, in addition to trying to gain access through the bureaus to more information, something that you may all be aware of is the birth of open banking, and never has that been more relevant now. So it's allowing consumers and businesses to expose their information to you in ways that previously weren't possible. So it means that if I'm applying and you think I don't look suitable, and you might not have access to the information that some of the big banks or the energy companies have access to. You don't have, through the principles of reciprocity, you can't get access to that vital information you need. All of you can get access to open banking data. I mean, it will require some investment in terms of the technology, but it means that you can start to allow your business and your consumer customers to start sharing information around their current account details. The other thing is you'll hear a lot about open banking, but the next thing is open data, and that is that you'll have Sage and Xero, and we're now working to look at how we can make sure that those management accountancy packages can also be surfaced to you. So again, that's not anything that requires on rules of reciprocity. From an economic point of view, you can only look at again, a bit like the data I presented to you today. Because the open banking and the open data is predicated on consent, then that's something that you all can benefit from without having restrictions around rules of reciprocity and data sharing limitations.
Thank you.
Okay. Anybody got and the next question? Another question? Okay. Well, thanks very much, Grant, for your time today. It is the data and stuff that you've got is remarkable. You've been collecting it for a long time, so that's really good. So thank you very much indeed once again, and great to have you on the call again. And I'm sure that we'll do a catch up a little bit further on. I know you can't talk much about what you're doing with number 10, so but good luck with that. The stuff that you showed was very interesting, and of course, as we've had on the call, the general consensus, certainly from the call on Wednesday as well, yesterday, the general consensus is that we've got about a two-month window right now until stuff starts to really get difficult in terms of organisations that start to get into trouble, and administrations and insolvency start to kick in as the grants and the various government supports mechanisms that they've put in place start to disappear. So thank you very much indeed, Grant. As I said, this particular video will be put on YouTube early next week. I'm now going to stop the recording.